Today we're going to talk about 10 stocks that you do not want to ignore at the moment. These stocks are great companies, great stocks that you want to own, and for me personally, these are 10 stocks where you would probably want to have at least 2 of them, maybe even more of them, in your portfolio. And personally for me, I currently have 3 of these stocks in my portfolio, but with what's going on at the moment, potentially I could extend past the 3 that I do own. But yeah, I thought these stocks are worth talking about at the moment because, like I said, they are great companies and some great companies that you want to own in your portfolio. And why these have been ignored a little bit at the moment is because they have kind of kept decent valuations and done well through 2021. In 2021, what happened is in the back end of the year, you had small caps, mid caps, growth stocks, anything with any sort of risk associated with it took an absolute battering, as you guys know, in the last kind of few months of 2021, and then going into 2022, they've been absolutely battered and sold off. So initially, you're looking at a lot of them small caps, growth stocks that have been battered and thinking those are where the good buying opportunities are, and they are for sure. I've been buying a lot of the small caps and growth stocks, and a lot of them stocks are down 50, 60, 70%, which is very unnatural. We don't normally have them sort of dips in them share price unless we enter a recession or a full-blown stock market crash, which at the moment we are entering a bit of bear market territory, but we aren't in a recession that justifies them sort of drops. So you've got a lot of them stocks at the moment at historical low valuations, back at prices where they were at 2-3 years ago. And what's happened with them companies, the financials have got absolutely amazing and they're creating massive buying opportunities. And at the moment, no one wants anything. Well, Wall Street doesn't want any risk-based stocks, so they're not very popular at the moment. But when they come back into favour, they will be obviously amazing companies that you would have bought on the dip. But now starting to join them is the big tech. There's a lot of big tech names that are starting to join them because it took a while for them to join in. Through 2021 they did absolutely amazing. It wasn't until really we got into the new year of 2022 you're starting to see a few of these big techs kind of flatline, maybe even drop a fair amount. So these are starting to show some great opportunities at the moment. And this is what I was just saying a few minutes ago. Some of these stocks that I'm about to show you, they are the gems of the stock market. They are the stocks, the big techs that grow, very safe stocks that historically grow profit at a really good rate, good profit margins, really good revenue growth. Normally have very solid balance sheets as well. Really fantastic companies that you want to have in your portfolio. You want to kind of have a good diverse portfolio with, like I said, probably at least 2 of these stocks in your portfolio. And as well as this, I tried to find a bit of research to kind of show like these are normally really good at buying opportunities. But when a lot of these big techs kind of flatline for a year, 2 year, or maybe have 20%, 30% drops, a lot of these stocks don't historically have 30% drops, and what history has proven is when these stocks do have 30% plus dips, then or they flatline for a long period of time, they normally turn out to be the best buying opportunities out there. Obviously, when you're in these buying opportunities, obviously fear starts taking over and people go, a few months ago, I'd love to buy these sort of stocks at these valuations, and then it happens, and then you start seeing people being, I don't know if I want to buy it now, or maybe I'll buy it if it goes even lower. That fear does start to kick in, and you want to be looking at these buying opportunities and go, historically, what does history tell you? Well, when these stocks dip this much, you could buy on a 20% dip, 25% dip, 30% dip. As long as you're buying it on quite a decent dip, you're looking at a long period of time and it's far recovered that dip and gone on to do very well on the share price. So yeah, we're going to go through these stocks today, and definitely ones to keep an eye on. So the first one is Meta, or Facebook. This one has really snuck up on me on the last few days because I actually didn't realize how bad of a 5 days it's had. It's down another 6%. Over a month, it's down 13%, and over the last 6 months, it's down 50% across the last 6 months. And now with Facebook, I was just posting in the Discord earlier this morning about this, is that, we're now getting back to prices that were in 2018, 4 years. You look at what this company's done in the last 4 years, balance sheet's got stronger, revenue growth's been amazing, profit growth's been amazing, and it's been absolutely slaughtered. It's crazy how low this one's dropped. And down at 13 times earnings. A company like Facebook with the likes of Instagram, still the Facebook platform, WhatsApp, Messenger, 4 of the most popular social media apps out there. And then you consider, if this metaverse does really kick on, obviously that's going to take them into a different league, but that's a video for a different day. But it's still a fantastic company, and there is the reason for the drop. We know that Facebook came out with earnings, we know they came out and they kind of shocked us with their revenue growth going forward. But even if worst case scenario, if this company trades or goes forward, growing at high single digit of 8, 9, 10% a year, then this company down at $187 at 13 times earnings is incredibly cheap for Facebook. And Once again, what has history told you? Well, when Facebook dipped in 2018 and it was down 35%, you return, even if you didn't get the bottom, let's say you got 157, you would have still made 131%, outperformed the market. During the CV times, it took a 32% dip. History tells you once again it was a really good buying opportunity. And even when Facebook flatlined for a while, it had a good period of time for a year and a half where it did nothing. Then it goes on a crazy run and outperforms the indexes, and that's what history tells you about Facebook. So Facebook is definitely one to be looking at the moment, and it's one that where I kind of got the idea from this video from is that I've kind of been ignoring Facebook the last few weeks, and then I looked again at the valuation it's at and the growth, and even if it stays at really poor growth of Facebook historically, it's still a pretty good opportunity. And then you start considering, well, what happens if Facebook goes back to double digit growth of 13, 14, 15, 16%? Then we start talking, we're in a really, really cheap stock here. So definitely one you want to add into the list. PayPal is a company that is not as much like Facebook because it historically doesn't have too many dips. It's a very steady chart until 2020. Now there is a couple of periods of times where it will go through a couple of periods of flatlining phases, but that's generally the stock market. There will be times where the stock price doesn't follow the financials of the business, but eventually you'll see over a longer period of time, if we go from 2017 to 2020, is that over a longer period of time, that stock nicely ticks up at the moment. And PayPal is very much the same. It's been on a massive dip at the moment. It's back at prices that it was at February 2019. You look at the progress of the company once again. 27 times earnings at the moment. This company, once again, you talk about gems of the stock market, massive amounts of profit growth, revenue growth, really good balance sheet. Same again, this company is a company that historically doesn't have that many dips on the share price, and you are buying it at valuations it was at three years ago. So definitely, as you guys know, I made a video on it earlier this week, definitely one that you want to be adding to a watch list. Adobe, the king of the SaaS model. These guys kind of changed the game when instead of paying £300 up front for Adobe Premiere and Photoshop, the monthly payments, and that monthly payments really benefited Adobe so much, and eventually everyone kind of went on to kind of copy that. Same again, a company that historically does not have that many dips in the share price. If you look at through this period of time, even through the 2018 dip, it was only down 23%, even down in the CV dip, down 18%. Same again, you get an Adobe now down 39%. You look at the share price has pretty much done nothing since the 2nd of July 2020, so just over a year and a half now. Still a little bit more of a richer valuation than the likes of Facebook and PayPal in my opinion, but still a fantastic company. The whole point is not to ignore these great companies because they normally don't go down to crazy cheap valuations because everyone knows they're fantastic companies. But you've got Adobe now that's flatlined for a year and a half. It's on a massive amounts of dip. One that you want to be adding to a watch list. So if this kind of gets down to the low price to earnings ratio of in that 30 range, you want to be looking at it. Google's a weird one. I always feel Google has been massively disrespected on the stock market. If you look at the likes of 2018 to mid 2019, this is the stock market for you. Google, the financials of this company was unbelievably good, and what happened for a year and a half, it got no respect. The share price stayed flat, and this is what you've always got to be careful of as an investor. You have to realize that it might be very frustrating because you see all the financials getting better in that company, and then for a year and a half the stock price does nothing. But with that kind of patience comes the reward, and you'll see here that it went on that run through that period of time. Now Google itself hasn't had too much of a pullback. It is currently having a pullback of around about 12%. But the big thing with Google is it does trade around at 23 times earnings. And once again, you consider that this company it's on a little bit of a dip. The share price hasn't done much for around about 6 months now. The growth is fantastic. Once again, these are kind of little opportunities. When we look here, it might be a bit of a patient game for a year and a half. This might continue for another year. But these little pauses in the share price, or these little dips in share price in these sort of companies, that gems of the stock market, you want to be looking at. And I think that the big thing with Google is that it's even on this crazy run, it's not at a crazy valuation. Amazon, obviously there's been the stock split recently, news about this one, but same again, I've never seen Amazon trade down at 44 times earnings. And once again, you look at the share price is currently flat for the last kind of year and a half. You look at the progress of the company, the share price is flat for the last year and a half, and History tells you once again, last time this was flat for a year and a half, September 2018 to March 2020, was flat for a year and a half. What happened? Boom. You had the respect come back in, the stock jumps out 73%. And this is what happens. Eventually, these jumps, this is why you can't time the market. You don't know when it's going to happen. And boom, it happens so quickly. You have the jump and then you wish you had the patience for it. And a stock like Amazon, sure, it's coming through a bit more of a, once again, like Facebook, it's having a bit of hard comps at the moment. But you look at Amazon in the next 5 years, is Amazon really going to struggle in the next 5 years? No chance. And you're picking it up at quite a lot of, a low valuation for Amazon and its history side of it. It's pretty much done nothing for a year and a half. It is one that you need to be keeping an eye on. Apple isn't, for me, this is probably the one on this list that definitely hasn't had the valuation check a lot of the other ones have. But you look here, it's currently down 11%. It's not really done anything for a couple of months, but it's still trading at 25 times earnings. It is. I wanted to give it a mention because it is a fantastic company, but this probably is one of the ones that breaks the valuation trend for me. But with what's happening in big tech, I would keep an eye on it. Microsoft is a bit similar to Apple. It's not really had the valuation checks like the other one, but a fantastic company. Down 16% at the moment. It's kind of flatlined, same again for about a 6 months period, not as much as the other ones. But once again, one to keep an eye on this one. 29 times earnings, does pay a bit of a dividend. This is one that I wouldn't say is a good opportunity as the other ones, but one of the gems of the stock market that you do need to keep an eye on at the moment. Apple and Microsoft, I would say that they would need to come back down to better valuations. Netflix, I don't think I've ever given this one a shout out on the channel before, but this one is probably a lot more volatile than the other ones. This does tend to have dips out of nowhere. You look here for July, that was a 37% dip. 2019 it had a 31% dip. So this does generally have a lot more aggressive dips than all of the other stocks on this list. And you'll see here that at the moment it's down 47%. Saying that though, I'm not a massive believer in Netflix. I prefer Disney because you get the Disney Plus and the parks and everything like that. But when you start talking about Netflix, that it's still going to be a very successful platform in the next 5 years, and then you start talking it's down at 31 times earnings. You look at the share price. The share price is nearly where it was at back at June 2018. Not my favourite on this list. It's not the likes of Google or Facebook or PayPal. But even me that's not a fan of Netflix, you've got to realise at some point, okay, it's not a company that I like as much as them guys, but you look at the valuation here and go, it's still a good company. And the valuation, 30 times earnings, it's not bad at all. So that's something to also add in. Nvidia is one that's been holding the indexes up through 2021, like the Apple and Microsoft. So this hasn't generally had as good pullback as some of the other ones on this list, but still, a 33% dip. It's currently flat over the last kind of 6 months. It is trading down at a P ratio at 57. So I would add list it more into the likes of Apple and Microsoft, maybe ones to kind of just keep an eye on. But it is starting to have a bit of a dip, and it's a fantastic company and one that you need to watch. Tesla. Now, Tesla is quite a funny one. It is on a current dip of 34%, and really you could say over the last kind of 13 months, Tesla has really not done anything on the share price. You guys probably know I own Tesla until I've owned it twice, and the last time I sold it was in November, December time. I sold it out just because I thought the valuation had just got so high. But now it's having a 39% dip at the moment. The share price has been stagnant, and sure, the valuation got high on this one, but it's a fantastic company. You can't deny it. The growth's good, the profit's good, and the longer this kind of stays at these sort of prices, the longer it kind of flatlines for a while. Tesla's going to be a massive company in the next few years as EVs grow and all the other kind of little incomes that they have going on. Tesla's going to be a fantastic company in the next 5 years, and it's one to kind of keep an eye on, very much like how Google flatlined for a year and a half until it went on a crazy run. The longer the Tesla stays down at these sort of prices, one to add on a watch list, because the valuation side of it is getting a lot more attractive from when it was 1,222 in November, now 795. So definitely one, the future of EV is in this company at the moment. So one that you want to be adding to a watch list for sure. And to finish off with, I saw this yesterday, which kind of sums up what we're saying here. And this is considering that some of these aren't at really good valuations just yet. The FANG index, Facebook, Apple, Amazon, Netflix, Google, these five companies, a new index that tracks them is currently having them stocks down at one of the lowest valuations it has ever been at. And that's considering that Apple and Microsoft are still kind of holding up there right now, which says a lot about the valuations of these companies. You know, these companies have been holding up for a while and now they're starting to dip. And history tells us when these stocks dip, when these stocks flatline, these come really good buying opportunities. Some stocks that you want to definitely have in your portfolio, some gems of the stock market with them profit growth, revenue growth, great balance sheets, and it's definitely one to keep an eye on. And I thought I'd just make this video just saying that these stocks are definitely coming great opportunities now. You know, we've known for a while the small market caps have been fantastic opportunities, and it can be quite easy to get too attracted to just buying the small market caps and the growth stocks at the moment because they're down so much. But while these have been down for so long and the big tech have been holding the value, it's starting to get to the point of view now where that big tech is starting to show a couple of cracks at the moment, and you're having definitely one or two at the moment at very good valuations. And don't start ignoring them because you're too focused on buying all these stocks that are down 60-70%, because these stocks aren't more than likely going to go down 67%. For them stocks being on a 20-30% dip is normally quite a big dip and historically proven to be a good buying opportunity. So I thought I'd just make a video shouting them stocks out. So hope you enjoyed the video. If you could, hit like button if you're new, subscribe, and I'll see you next video.